Well, hello everybody, welcome back to another Forex market analysis session. My name is Alexander Nikitin. I am a professional trader and a programmer as well. If you guys are new, what I'm doing here, I'm looking at some good opportunities that might happen next days, and I'm explaining some aspects of technical analysis and psychology of trading as well. If you guys are following me for a while, thank you for your support, thank you for your thumbs ups, thank you that you share this video on social media. So let our community grow. Let me have more subscribers on my YouTube channel. I really appreciate that stuff. Okay, so let's start our analysis. Today we'll have a very informative video, so take your notes, grab your pen and paper, grab your coffee, sit back, relax and enjoy the video. I'll do the same. Let us start then. The first, I want to say that I am analyzing pound dollar. My analysis consists of two parts. I first analyze the higher time frame and then I switch to my trading time frame. On my higher time frame, I am to identify what price is doing now and to predict what price is most likely to do next. And on my trading time frame, I am to decide how can I get involved and to actually execute the trade. Okay, identify, predict, decide, execute. It is IPDE process. Look at the whole picture. Look at this movement to the downside. We are obviously in a downtrend. If you are familiar to Dow Jones theory, then you should know that a downtrend is a series of lower lows followed by lower highs. Low, lower low, lower low, followed by lower highs, lower highs. So only when you have it this way, you have a downtrend, and an uptrend is opposite. Okay, hope you understood that. And if you are familiar to a Gartley pattern, then you should see that it looks this way. We have a movement to the downside, then we have a movement to the upside this way, and then the movement to the downside resumes. Okay, and if you are familiar to Elliott waves, so you also know about this Elliott wave pattern. We have 5 waves to the upside, 1, 2, 3, 4, 5. Then we have 3 waves to the downside, A, B, C. And after we have this A, B, C, the 5 waves to the upside appear again. 1, 2, 3, 4, 5. So A, B, C. What I want you to pay attention is that this wave number 5 is shorter than the previous wave number 3. You should understand that. It is shorter and then ABC zigzagging structure appears. This leg is shorter than that leg and only then ABC structure appears. Ralph Nelson Elliott wrote his books in 1920s and Harold Gartley wrote his book in 1930s. Since then, these patterns appear themselves again and again and again. They are talking a bit different, in a bit different ways. They are explaining the same themes but with different words. But these themes worked 80 years ago, 90 years ago, as well, almost 100 years ago in 2020. We will have a 100-year anniversary of Elliott waves analysis appearance. It will have 100 years. Okay, look at this movement. Downside, long downside movement, correction, and the smaller movement. And this smaller movement followed by a zigzagging movement in the opposite direction. After that zigzagging movement, we have that reaction to the downside. Sometimes we have it lower, like this. Sometimes we have it lower. Sometimes we first go to retest the previous structure highs. Yes, look back, look left, structure leaves clues, previous structure, and then we roll over to the downside. Nowadays, these patterns are drawn this way, as two connected triangles, so the Gartley pattern is recognized easily here. Large leg followed by shorter leg, then we have a zigzagging formation, yes, and the movement to the downside starts. You see? Let me make it more familiar to you so you can recognize the Gartley pattern. Then we have a retest. Sometimes we have it, sometimes we don't have it, that retest back. So actually I take the profits on this smaller movement, so I don't look for extending targets of that, because in this case I should place my stop loss in the safety place, and that safety place is a very large number of pips to risk. Okay, what is next? We have a movement to the downside, another short leg like this, here, here and here. Then we have zigzagging formation. Yes, if I unite that, you will recognize a Gartley pattern. Gartley formation. Well, the Gartley pattern is a specific pattern with specific ratios assigned to that pattern, and it belongs to Scott Carney, and Scott Carney is very jealous about the Gartley pattern. He says that the Gartley pattern is his mental property. So the Gartley pattern is only valid if it meets Scott Carney's rules of harmonic trading approach. But what Gartley, Harold Gartley himself described in his book was simply a zigzagging formation. It was very vague, not that precise as Scott Carney's Gartley pattern, and so we shouldn't call him a Gartley pattern. We should call it I don't know, something like Gartley description, something like 222 Gartley picture. I don't know how can we call it in order not to offend Scott Carney's mental property. Okay, so what do we have next? We have movement to the downside, we have a kind of correction, we have a smaller movement to the downside as well. Yes, so I am expecting this zigzagging formation to appear as it appeared previously, and then the price will either move straight or it will move after a retest. Let me unite those things and you will see the Gartley pattern. I am drawing these Gartley patterns without any Fibonacci ratios. Many times I was asked from newbies traders to explain them the ratios, and my only answer is, first, you should study the structure of the pattern. Do not repeat my own mistakes. First, understand the structure of the pattern. What is the structure of the pattern? That you have a movement followed by smaller movement, like this, movement followed by smaller movement, and what is most important, you have that zigzagging formation. 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 So before you study those ratios, you should see those zigzagging formation. It doesn't really matter what ratios do you have. After you see that zigzagging formation, you will understand the approximate zone for a reversal. Some approximate zone after that zigzagging formations. Okay, how will you choose that zone? It depends on your rules of engagement, depends on your depends on the pattern you trade. I personally trade the advanced pattern formations, so this zigzag information should be exactly of advanced pattern ratios, and only then I will enter into this market. I'm not using the ratios of Scott Carney because I truly believe that the market will reverse if it doesn't have any harmonic movement. So I am against that harmonic approach. Let me explain what I mean. The Scott Carney says that the market is harmonic. If you copy and paste that movement, if you see that equal distance movement followed by pullback followed by a movement, you usually have a reversal, something like that. That's why it is called harmonic approach. So he's thinking this way. I'm thinking opposite. I'm thinking that you should have a movement and then you should have a smaller movement. And this smaller movement indicates that the upside zigzag information is losing its momentum and the price is ready to reverse. How do I understand that the movement is losing its momentum? I am using that channels. You see, if the movement is equal, it tests the border. If the movement is not equal, it doesn't test any border. It violates the channel without harmonic movements, something like that. And usually we see that kind of picture. Usually we can see this kind of picture. Well, this is another way, trading without any ratios. You should have here, I just forgot, have a higher high and higher close above the previous B point. If you are familiar to Gartley patterns, you should have it this way without ratios, and you should have a lower low lower close below the channel border. If you have a lower low lower close and the highest point between this C point and that lower low lower close doesn't test the border's channel, and you don't have the one-to-one harmonic movement like this, you don't have it this way, yes? So this indicates that the price is upside movement is losing its momentum and the price is ready to reverse. It is very conservative approach. Another approach is to combine the Fibonacci ratios and to place a sell limit order without waiting for a confirmation that price moves to the downside, violating the border, and then to enter this way. Well, it's up to you either to use a aggressive approach or to use a conservative approach. This is a conservative approach, and aggressive approach will look like the combination of ratios. So what Scott Carney does, he calculates the ratios, he defines the potential reversal zone where the price will most likely to reverse. Then he is looking for a trigger bar to appear. That trigger bar should coincide with RSI overbought oversold condition, and this trigger bar should look like a rejection bar. It looks like hammer or Morningstar or doji or whatever in this potential reversal zone. And the points between that trigger bar and the B point should show the RSI divergence, RSI, yes, with price. If I draw that, if I draw it on my chart, yes, this way. So it should show that price is installing those higher highs, and on RSI it should look like you have lower lows. This is called the divergence. In this case, when all these factors combined, the price starts to move to the downside. Well, I think that's not because of ratios, that's not because of Scott Carney's harmonic approach. The price starts the movement mostly because of RSI divergence. too many factors combined in one single approach. So if you are looking for some ratios, this combination of ratios gives you enough. You don't need another confirmations. The combination of ratios give you an edge. You just place a limit order. If you are trading a price action within some potential reversal zone, so it doesn't really matter how do you define that potential reversal zone. You can find it well as a structure point. Look at my indicator. You have those green zones, you have those red zones. Every time the price touches the green zone, you may look at that rejection bar. You can look for some RSI divergence or overbought oversold condition, and you can trade them as well without any Fibonacci ratios. So this is, I don't know, absolute nothing, those Fibonacci ratios in harmonic approach. Absolute nonsense. If you are trading RSI, you don't need the Fibonacci. If you trade the Fibonacci, then you should have a special set of ratios for trading that Fibonacci. That's why I like the advanced pattern formations as contrary to harmonic patterns. Okay, let me zoom it in. Let me scan the market with my advanced pattern formation recognition tool, and you will see that we already have a Gartley advanced, a Cypher advanced formation triggered. The price came to the upside. You see it hit the entry level, so big buyers are already in this trade. So most likely here the buyers will step into the market to close their short positions. Big sellers already short with this trade, and they will most likely buy back their position here. So if they buy back the position here, the price may bounce a bit to the upside, and in this case we will have that zigzag information that I was talking about. So my plan is to wait until price reaches this broken resistance level. You can see it with my indicator. It shows major support and resistance levels. You can see it here. When price goes here, and if I have any opportunity to buy it somewhere here, maybe a bit lower, somewhere in this zone, then it will be a great opportunity to go to the downside. If you are trading daily time frames, well, you are welcome on board to short this cipher pattern. If you have that cipher pattern on your rules of engagement list, if you have it on your trading plan, well, you are welcome. It is valid cipher pattern. You can trade it to the downside if the daily time frame is what you actually trade. I'm not trading daily time frame, so I will switch to my 4-hour time frame to see some opportunities for entry. Okay, switching to my 4-hour time frame, and you can see that resistance zone that is shown here. Actually it looks this way: the resistance zone, and to place the stop loss below that level, to enter somewhere here, maybe a bit lower, and to place the stop loss below this level, because we know that those lows are very often they are tested before price goes to the upside. They are tested very often. So if price goes here, this is the initial point of that reversal zone. This is the starting point, and it may go deeper into the zone, yes, that is marked with silver or gray. So we can have that movement to the upside somewhere within this zone. Okay, let me show you something else. I will analyze the market with my advanced pattern recognition tool, with my pattern search tool. Okay, large pattern gives us nothing. Large swing pattern search, medium swing pattern search gives us a cipher pattern exactly at that ratio. Let me show you something. The completion of that cipher pattern, it coincides with this resistance level. if I go a bit deep into history, resistance level, acted as support level here, acted as support level here, resistance level here. So you can see the power of this level. So, and those support and resistance levels are acting as magnets. So if price is moving to the downside, this is very attractive movement until price reaches that level. The sellers will prevail in the market because it is very, I don't know, magnetic level. And after that, the sellers will start closing their positions after that. So, and it will result that this cipher pattern is working to the upside. We'll have a bounce to the upside. Well, this is the cipher pattern that is on my radar. I'll wait until the price completes the pattern. If it completes the pattern and goes deeper, I will get involved at 1.2342 with targets at 1.2468. You can see it on my chart, and stops with 1.2216. Well, that's it. Hope you liked that video. If so, give me your thumbs up, share this video on social media, let our community grow. Subscribe to my next video if you don't want to miss new editions. Until then, good luck, good trading. Hope to see you soon.